Hello and welcome. This is Abhinav, and in this video, and starting from this video, I'm doing a series of videos for people who are looking at moving their business abroad, maybe to the UAE free zone, or setting up presence outside India with an intention to avail tax savings. Right? There is a really hot debate going on with respect to the ROI, with respect to the tax that we pay in India, businesses pay in India, and with respect to the general concerns around ease of business. But while doing all these things, what people sometimes do is that they have a very kind of a narrow or a limited focus on the tax saving aspect that they will get. So I always say that tax saving is only the icing of the cake and not the cake itself, right? So my point here is that in this video, what I'll be covering is that one needs to look at it holistically from all angles and not just only the tax angle. And if it ticks all the boxes, then only you make the move abroad, because moving your Indian business abroad is a long term kind of a task, right, which has a lot of implications, not just to you but for your clients, to your employees, and most importantly your family, right? So that decision has to be taken holistically, and if need be, some professional should be consulted, some second third opinion should be taken before taking that decision. And it should not be taken impulsively, and all the regulations should be checked, because there are a lot of kind of what I will say, things that can ruin your entire structuring, right? So in a series of videos, I'll be trying to cover all the things that, from my little knowledge, I will try to put it to you, and then those pointers then you can use in your structuring. And I routinely help businesses making a presence abroad. So if you want to take a second opinion, then you can consult. Okay, so let us start. The first point, the factors when you think about choosing a jurisdiction. Which jurisdiction is it? US, is it UAE? The UAE has a free zone, which is lot of people prefer. Then Singapore is a very famous jurisdiction and very good jurisdiction, which one can choose. And then there are many other jurisdictions. So one is that you need to see how the ease of doing business, because see, understand one thing, that you are not just going to set up that company just for the sake of it. Just see, you are not going to, and don't be under that impression that I just set up a company in the free zone, one of the free zones in UAE, and that's it, I will save all the tax in India and everything. No, it doesn't work like that. If someone has told you, it's a myth. Second, understand that wherever you set up shop, whichever jurisdiction, you need to see the rules and regulations and the ease of doing business, and you have to actually do business activities from that jurisdiction in order to claim the benefits under the treaty, benefits under the tax regimes and everything, right? For example, even if you set up a business, a LLC in the free zone in UAE, there are a set of conditions that you need to adhere. Only then you get a tax free status of your business. So you need to see ease of doing business, how easy it is doing business in that particular jurisdiction, right? And a lot of people who just think about tax saving should also think that the comparative ease of doing business with respect to India, with respect to all the GST challenges and all the kind of tax litigation, or if I can use the word tax terrorism in India, compare it with that country, how that country's rules are, right? For example, Dubai is like a very good jurisdiction in terms of lot of things, ease of doing business, the quality of life, the infrastructure, right? So I'm not going giving example only of UAE, but think whichever jurisdiction you are choosing. Then reputation of that jurisdiction. See, there are many jurisdictions, many countries, but not every country has a very solid reputation, right? So some countries, like if you incorporate a company in like the Cayman Islands or Panama and all these things, definitely there are tax benefits that are involved, but there is a certain reputational kind of a shadiness that is associated with certain jurisdictions. People think that you are just incorporating there to evade tax, right? So always always keep that thing also in mind when you choose a jurisdiction. It should be how your business clients, how your employees, how you people perceive that jurisdiction. That is also important from your business's long term perspective. then impact on your marketing and brand positioning, right? So always when when you choose a jurisdiction, you should think of that, okay, what is my existing client set, right? So for example, if you have clients in the Middle East, then maybe UAE or Dubai company would be the best thing, right? Because they are more kind of open to I mean engaging with such a company. But if you have like clients which are in the far east side, like Malaysia or Japan and all those sides, then maybe a Singapore company is more kind of suitable. So also it's not just tax saving, also think about how the, because that jurisdiction will then become your face, right? Unless you want to keep the India jurisdiction, because then that's the other thing, when then all the taxes and all will be payable in India. But if you are moving to Dubai, how your customers are going to treat you, how they are going to perceive you, right? So think on that. Ease of getting funding. Now, when you are incorporating there, maybe at a later date you might need funding. Some businesses don't; they have internal accruals. Some businesses need cash. For example, tech companies, they need funding, right? So maybe a US LLC or maybe some incorporated entity in Singapore is beneficial as compared to an entity in UAE, because sometimes they have some concerns with respect to these the countries like UAE, Saudi, and all. They are like owned by kings and all. So maybe they are not seen as favorably. Then there are FATF concerns with these countries, as compared to that Singapore is a very very transparent and jurisdiction, so that can be evaluated. So think what your future investors, VCs, would prefer you incorporating in that which country, and then also that is also a factor. Then see whether there is a DTA between India and that country, because if there is no DTA, then you cannot kind of avail certain benefits under the DTA. You cannot avail reduced withholding rates in India on certain payments to that entity, right? In that jurisdiction. So always it is advisable that there should be a DTA. Now the terms of the DTA also have to be right. Not every DTA is a sound DTA, right? For example, in you compare US UK DTA to a US India DTA, there is a kind of sea of difference in terms of the benefits that one gets under the DTA. So whether the DTA exists, what are the provisions of the DTA, then you have to read the provisions of the DTA with the multilateral instrument, because now the, as per the BEPS action plans, the MLI has also come. So you have to also see the whether the MLI provisions, which MLI provisions are incorporated. So all that thing have to be evaluated between India and that country, right? Okay. Then you have to look into the rules, the tax rules, the VAT rules, GST rules, exchange control. Like we have FEMA in India, Foreign Exchange Management Act. They have, that particular country can have also its exchange control rules. So you may have a lot of profit generated in that country, but that country may restrict repatriation of profits outside India. Like in India, we have the LRS, a liberalized remittance scheme, where you can only remit up to USD 2.5 lakhs per year. Similarly, that country may have certain exchange control laws or regulations, right, which limit or restrict the how you repatriate profits outside India. See, ideally you would want to choose a country which has very very kind of less restrictions on all these aspects. Estate inheritance tax rules, for example, in UAE there is no personal income tax, no estate tax, no inheritance tax, right? Then immigration policies. What are the immigration policies? Suppose you decide later on, once you kind of incorporate into that jurisdiction, and you want to get a citizenship, you want to surrender your Indian citizenship because India doesn't allow dual citizenship. You want you and your family to migrate there. And what are the immigration policies? If at a later date you want to surrender citizenship there, would there be some provisions to, like in US there are provisions with respect to expatriate tax, right? So would there be some provisions where they will deem every all the unrealized gains and as income and tax that, right? So you have to also see the immigration policies, then the those related rules in that foreign jurisdiction, right? Then costs of compliance. Now it is very very easy to think that okay, I will incorporate a company outside India and save on tax. But friend, my dear friend, there are several costs of compliances. in that particular jurisdiction, even if it's a zero tax jurisdiction like a free zone in UAE, there are still there are costs of compliance that you need to do. There are one time compliances, and then there are recurring compliances. So you need to also make an estimate of those costs vis-a-vis the long term kind of tax saving, the increased sales, all that thing, and then take a decision. I have made a separate video. I will be making it shortly in the series of videos on the costs of compliance in moving abroad. So it's not just the cost of incorporating the company. There are whole lot of compliances in India that you have to also do, and there you have to do, right? So all that has to be evaluated. P risk, right? So always it's a wrong notion to just think that, and when I move business abroad and I continue my business in India, I will save the Indian tax. No, Indian tax authorities are not that dumb. They have proper rules and regulations to tax that income in India, right? So you have to basically ensure that if you don't want the Indian income to be taxed, you have to ensure that it doesn't qualify as a P. First of all, there has to be a DTA between that country and India. And second thing you have to ensure is that they should not, the Indian operations of your business should not qualify as a P. Otherwise, then whatever the tax saving that you are trying to get will all be lost, and India will be treating the whatever the income accruing to the India operations to tax in India. So I will be making a detailed video on the on how to manage the P risk when you move operations abroad. So you need to check that. Then okay, then if you move business outside India, when you talk about the tax saving, that okay, you have a LLP in India which is kind of subject to 30% tax. Now one of the partners of that particular LLP will remain as an Indian resident, right? So with respect to that particular partner or a shareholder in the overseas business that you will incorporate, uh, will remain an Indian resident, and that for that Indian resident, as regards whatever dividend or income that he earns from the overseas business, will continue to be taxable to him in the Indian tax return, right? So you have to again decide, right, that if there are four partners, three partners are non-resident and one partner is resident, so with respect to maybe two partners are resident and two partners are non-resident, so when you talk about the tax saving of the entire business, so definitely there will be tax saving for the resident partners, but that will be reduced because in their personal assessment they will be taxed with respect to their world income, right? So if you want to totally come out of the Indian tax net, then you have to move out of India, right? Whereby you are a non-resident as per the Indian Income Tax Act, you are a non-resident as per the FEMA, right? And then you totally move out of the Indian kind of net of the Indian regulations, right? And basically also move your Indian business operations out of India with time, right? So that also has decision has to be taken in a kind of a step by step manner, right? So one fine day you have businesses, employees, everything in India. You one fine day you cannot move everything outside India. So that has to be well thought out, structured approach where you may decide that because of the ease of doing business, because of the various benefits that my business will get by being in a outside jurisdiction, which far outweigh the benefits that one gets by being in India, then you have a kind of make a clear plan that okay, year one I will do this, year two I will do this, year three I will do this. So it can be like a 3 to 4 year plan where you move your entire operations outside India, right? So with that perspective you have to look into it. Extent of presence you need to evaluate. So when you think about expanding outside India, you need to see whether you want to create a wholly owned kind of a subsidiary company in that particular jurisdiction, or a mere license office, or a kind of full-fledged office, full-fledged company, because the implications will be different, right? For example, if there is a proper LLC that you set up in, like say, US, now even a LLC which is treated as a disregarded entity in US, there is now a favorable judgment. I've made a video on that a few days back only, the General Motors case, where they've held that US LLC will be treated as a separate entity for the DTA purposes, and it will get whatever the tax advantages are under the India US DTA. So you have to see extent of presence. Only a small kind of a branch office you need to set up, or you need to set up a full-fledged kind of a presence where it's a separate company structure where you are the directors, right? So then what are the rules with respect to nominee directors, right? A local director, some countries have those requirements, some countries don't have that requirement, right? Because so that again you have to see. Okay, very very important. If you are a Indian resident individual or an Indian company which is setting up a presence outside India, whereby you kind of create a subsidiary, right? You need to comply with the Indian FEMA ODI regulations, overseas direct investment. It qualifies as a ODI. Your investment qualifies as a overseas direct investment. You need to make those compliances being a resident, right? And please understand, under FEMA, the contravention implications are huge. For example, the whatever is the amount, quantifiable amount, you have to pay three times penalty, right? If there is a contravention, and RBI and the ED are very very strong, strict in terms of kind of in those cases of contraventions, they ask for doing a compounding, and then in compounding you have to reverse the whole transaction. You have to liquidate that company, bring the money back to India, then apply to RBI for compounding, and then there will be a compounding. Under the compounding order, there is a penalty that will be levied. So to escape that, you need to be very very particular with respect to the FEMA compliances. I will make a separate video on the FEMA compliances with respect to setting up companies or offices abroad, and what are the main kind of compliances that you need to ensure. So if you are a resident, you have to be very careful to take care of those FEMA compliances, right? Then buying from your employees. Now, so when you are incorporating a company like in a Dubai free zone, right? So you will not just be incorporating a company. It has to be an office. There has to be certain set of employees who will be working from that office, who will be doing the outward kind of solicitation and marketing work. So if you have like 10 employees in India who are currently working in India, you may decide that you may need to relocate at least 2 3 employees uh, in UAE. So if you are doing that, you need to get a proper buy-in from the employees. There are certain cost of living, in UAE, which is far higher as compared to India. So your kind of salary payments to them has to be also in accordance with the cost of living. And then there are employee related compliances in countries like UAE and other countries. So you need to also take into account that buy-in from your clients. So when you are incorporating outside India, to escape the PE risk, you need to basically enter into fresh contracts with respect to your clients, right? So maybe if you have a company in India which currently has its contracts with like the various clients spread in various countries, you need to kind of close those contracts and migrate those particular clients to the UAE company books, where you execute fresh contracts with those companies. Now, when you do that, there will be certain, you need to get a buy-in from the clients, how ready they are, and their concerns. So you need to have those pre-discussions with them, right? That this is what we are trying to do. And always in all your company communications, do not just say that we are moving because of the tax, right? Because there are certain kind of triggers with respect to the Indian GAR provisions. If you are only doing it from for tax, or another PPT provisions, where you say that one of the purposes is tax, don't say tax. Say that it's basically our broader intent to gain market share, or put all around those lines. But you need to also get your buy-in from your clients, take them on board with this decision, because this is basically a transition, it's a migration, right? Then buying from your business partners, right? So again, there are various structures that are possible in this transition. There may be like, you may move entire operations outside India, keep some operations in that country, have an Indian company which is taking care of the Indian operation, Indian activities. Then maybe they have two independent companies, maybe one in outside jurisdiction, one in local jurisdiction. So you need to also get a buy-in from your business partners as to their roles and responsibilities, who will move to the outside overseas jurisdiction, what will be the share of ownership in the foreign company, right? And ensure that everybody's interests are taken care of. None of the business partners should feel that because of this transition, I was left out, right? Because then they are like your business partners are the pillars, your employees are the pillars. So if anyone like feels left out, then whatever the tax that you may be trying to save and all, that may get wiped out, because of the other things that may happen. A business partner may decide to move out because he was not taken into confidence. So you need to take all the stakeholders into confidence before making this important decision. And then most important thing is buy-in from your family member, especially because if you see, a lot of countries regulations require the board meetings to be conducted in that country, the person to be present in that country for that particular period. Only then you get the DTA benefits of incorporating in that country. So if that requires you to move to, like, travel to Dubai, live in Dubai for certain amount of time, right? Now your family members are in India, so what is the long term plan? Will you be moving them to Dubai? What are the kind of lifestyle and everything in Dubai? Will they adjust? What about the social network in India? What is the long term plan? So you need to also get a buy-in from your family members before making this kind of a decision. So yes, so this is it. These are some of the points I hope I have given you some of the pointers where you can maybe think about, and not just think only from a narrow focus of a tax perspective, right? So I hope this video was useful. Do share your comments, thoughts in the feedback in the comment section. Thank you so much for watching this video. Thank you so much.